Hi, this is David Friedman for TCA Crossroads. I'm one of your hosts, along with my co-host, Dave Berkus. How are you, Dave?
I'm doing great. And if you're going to comment on my shirt, just go right ahead.
I like it. I think it's bright and cheery. I mean, we're heading into the summer months, and it's sunny outside in Southern California. So I think you match the sunniness of the day, and you have a sunny personality anyway.
Gee, shucks.
Yeah, gee, shucks. Yeah, I know.
So what's happening in the Orange County ecosystem, David?
Yeah, so I'm glad you asked that. I mean, it's been a couple of weeks of a lot of innovation. We had OC Innovation Week. We had Octane presenting their Technology Innovation Forum. We had presentations. We had a lot of the new ideas coming out of UCI in their engineering school, in their life sciences school, talking about new innovations, new products, new businesses. And we also had the Stella Zhang Beal startup competition that just ended. I won't share the results yet, but that was exciting. Several months of work, hard work by about 110 different startups with some affiliation to UCI. You don't have to have the entire, it's not only UCI students, but there was some very, very interesting ideas that can maybe be the next big company and big surprise.
All right.
So, excellent time. Just, you know, it's exciting and it's energizing to be around so many smart people and young people that have great ideas.
And I've been able to see this in some places like Purdue and other places in the heartland that you'd never expect to see these kinds of entrepreneurs coming out and forming companies that are real, that have value all of a sudden. We have a couple more that have come out of the universities and made a lot of money. So we investors would love some of these. The opportunities are great. And these kind of competitions give us exposure. So good.
Yeah, I so echo that. You know, for all the listeners out there and the viewers, if you know of companies, regardless of where they are in the country, TCA Venture Group invests in companies in the United States, in Canada. We are aligned with many syndication partners. We're more than willing to listen, to hear your pitch. The application is free. Just go online, www.tcaventuregroup.com, because as TCA Crossroads says, this is where investors and entrepreneurs connect. That was my segue to today's discussion.
Okay, you can do that. And by the way, if this was a Super Bowl ad, that would have cost you $6 million, David.
Well, good. I can now put that back in the bank, I guess. But today is exciting because we have a really interesting guest. We have George Brandon. He is one of the managing directors, MDB Capital, with a subject called Shortening the Window to Liquidation. Now, this is really important for two reasons. Number one, us angels want to see liquidity a lot faster than we've seen in the past. And this may give us another opportunity. But also, as we invest in companies, the opportunity exists for MDB Capital to take these IP-focused entities public. So I'm going to turn this over to you as we bring on our guest, and you can do the introductions and kick it off.
I'll do that.
So, hi, George.
Dave, how are you?
George, what a coincidence.
We were just talking about you.
What an amazing thing.
Really honored to be here. Thanks for having us on here. Appreciate it.
Thank you. Okay, well, I'll kind of take over right now. First of all, George, we've met more than once. I was more than impressed with the idea when you first began to present it, even before TCA had a chance to react to it. And so I've been an advocate from the very beginning, and that's one of the reasons why I'm kind of happy to talk to you today. So if we'll start by having you give us a little background. You heard from David. You have more of an ability to tell us how MDB fits into the early investment scheme. Let's give you a few minutes to tell us just that.
Absolutely. Well, first of all, I want to thank you again for having us on, and it's an honor for us to be involved with TCA. Did a lot of work on angels across the country, and I don't know if everybody knows it, but really TCA is considered kind of the one of the top groups. Our headquarters is in Texas. We have some great angel groups, CTAN and North Texas Angels, with some great groups up there. But it's just really great to be here and be involved with what TCA is doing. So that said, MDB's been around 28 years. We're really a difficult firm to kind of explain exactly what we do. It's hard to do an elevator pitch, and probably we're not great marketers at it. But we do venture, kind of a hybrid version of venture over those last 28 years, where we take companies from a seed investment to IPO, typically in 12 to 18 months onto NASDAQ. And that sounds very unusual. You guys are old enough to remember the 90s was a lot of it. We call it public venture. So, if you take anybody who's 40 or below, they'll tell you, you can't do that. It's not possible. And, these companies that we've done 17 of them. Right now, we're presenting number 18 to TCA. They're doing our diligence on it. So we have number 18 in front of the TCA group now. And we call it's public venture. And really what David had mentioned previous is, and all of us, I'm 65 years old, all of us are getting older, that the average hold for an angel go from, or venture, 7 to 10 years, angel 11 years, it's getting tough. It's getting harder to do that. And so I think what we are at MDB, and we have a track record of doing this, is a subset of what angels are trying to do. Because I think angels are the perfect investors to help find these big disruptive, for us, it's IP driven, it's deep tech, typically, technologies, and bring them into the public markets, early. Now, you've heard it before. Am I explaining that well enough that someone who hasn't heard it would understand it?
Well, George, you ring my bell, because the 11 years is exactly my years to liquidity. And I'm measuring over 209 now investments.
Wow.
So I have a pretty broad horizon, and 11 years is a long time.
Yeah.
And what it does for the angel groups often is members will join, and sometimes if they've had no liquidity event in 5 or 6 years, they'll leave. And so one of the ways we prevent that type of turnover is just the very thing you're offering. So tell us more.
Look, I think the fact that you guys here, I'm talking to two kind of, I'm not trying to flatter you, but you guys are kind of legends in whether you know it or not.
Legends in our own mind.
Well, no, you're not. This is talking from other people, and we're doing our diligence. And, TCA was pretty out there on the cutting edge of angel investing. And I think the very fact that you guys are willing to entertain kind of a new concept, it's not new for us. We've been doing it 28 years. I mean, we've been, testing this, and now we're starting to scale it. I really do believe that this public venture model, this seed pre-IPO funding to IPO, is going to be a very important aspect to keep angels involved, keep them engaged. And, a lot of angels that I talk to, they vote with their feet. They don't say anything. They just go away, and you lose them. And we can't afford to do that in this country. We have to innovate. We got to continue to fund innovation. And I think the angels that have been trained over the last 25, 30 years, there's a lot of them that are on the sidelines doing other things that we need them back. And I think public venture is one of the ways to do that. And that's why I'm working with TCA.
So I completely agree. And by the way, mine is 33 years. So I got you by a few years. But the whole point is, waiting that long is difficult, especially in my case, where I run 3 of the funds for Tech Coast Angels. We have limited partners, I hate to say this, who leave or die. And so, the longer you wait for some of those liquidity events, the more difficult it is.
Yeah.
So tell me more about the public nature, the way in which you take a company public, and after that time, the liquidity availability. Is there a holding period?
Yeah. So, let me hit as much as that. And if I miss it, we'll come back to it. So you got it's important to understand that it's not magic. It's not simple. And like with anything you do, you're as good as the companies you get behind and you pick. If you don't curate good technology, you're going to have problems. I don't care what your model is. If they're bad companies, poorly run, they're not going to work, and it's not going to be sustainable. So we have a very, very deep diligence process. We have a great diligence team. We look at intellectual property. We have our own IP strategy law firm that we own wholly. And so anything that we're going to get behind, we only want to fund leaders. It's typically deep tech driven it's coming out of a research lab or a university. We've done a couple of UCLA companies. One of our biggest deals ever came out of UCLA called Medivation. I think our biggest deal we'll ever do came out of UCLA, and we just took public last November it's called Exozyme, and it's trading on the NASDAQ. That's a UCLA Southern California technology. So we look at, those kind of companies. We do a lot of diligence on them, and they've got to be big enough ideas that they can live in the public markets, that people would go, okay, this makes sense. The data is good. You got to understand the inflection points, and that liquidity could come in, and then investors could have, liquidity, but if these are big enough ideas, by the way, we go from seed to IPO. IPO is not the exit for us. That's the B round. And so it gives you liquidity. You have the opportunity to be marked to market. And by the way, that's sometimes not a good thing. You get to see your portfolio marked up and down in the markets. Right? You don't get that in the angel. Every day you wake up and, hey, I know what I invested. I don't know what it's worth today. Maybe I get an update today.
That trick, we're talking about liquidity at a point in time when you start to the time it exits into the public market. You have that liquidity. Now, let's go back to the early discussion relating to angel investors. So we've been angel investors. We find a deal. Let's say it comes out of a school and they need a pre-seed or a seed round. We take it. Tell me and show me or share with us how you work with an angel group to make it better for the angel to get that liquidity.
Yeah. So, really, our whole network is non-institutional. It's angels. So we have about 600 angels in our network now. We're going to go to probably 2,000 or 3,000 over the course of the next 2 or 3 years, however long that takes. So it's always been angels for us. And so when we're looking at a seed investment, we'll find the company, we'll diligence the company, we'll put it together. Sometimes we have to give them some capital to get it going. Typically, there's a huge investment in that technology at the university level, whether it's grants or.
Yeah, but let me just hold on a second, because now I agree with you if you took it right out of like UCLA, like you said. But let's say now TCA invested in a company called the George Brandon, a molecular company. Okay. Now we've invested in you. How would you work with us to take that company going forward into a liquidity position?
All right. Well, it's a great question. So if that gets through our filters and we decide, hey, this is a company that could do well and survive and flourish and thrive in the public markets. Hey, TCA, let's work together. We're going to take this into the public markets. Now, I'm under the assumption TCA's made the investment, right? We've already made the investment into the technology. So we would come and say, okay, in that case, is that company mature enough now to go into the public markets already? Does it need another little bridge round before? And everything we do is 100% equity, unlike the venture. And sometimes this venture guys don't like to hear this. We're not doing any preferreds or waterfalls. I mean, if someone comes in and writes a big check, we're going to give them a preferred that would give them the right to be on the board. But we're all equity. Everybody wins equally. It either wins or we lose. We're going to lose together. We're going to win together. So let's say if it was ready to go IPO, then we'd come and say, hey, TCA, you got an investment. This is a great technology. We believe in it. We're going to take it on to NASDAQ. Let's say the valuation is $35-40 million pre-money. We're going to raise a minimum of $15 million because that's kind of what you got to raise to get on NASDAQ. And we're going to take that in. Now, if TCA, I got to tell you, you're going to be tied up for 6 months post-IPO.
Sure. That was my question.
Yeah. We're going to be you're going to be tied up like every venture firm. And the other thing I'm going to tell you is, hey, do you really believe in this? Because we're not doing the IPO unless we think that's got a shot of being $1 billion company. So here's the problem with investing in a company that could be $1 billion company. And we've had 5 out of the 17 deals we've done. We've had 5 unicorns. Now, percentage wise, that's pretty good. Now it's a small pool, right, of 17 over 28 years. So, but I would go, hey, TCA, this horse can run. It's not a quarter horse. It's going to run the whole lap and a half. And the hard thing about a big idea like that could be $1 billion company. It's good luck holding it to that. So we're typically not getting behind something that you would think. You got to understand that most people believe that the IPO is the end of the road. You pop the cork. It's, we're going to celebrate it. It's a B round. And it's a hard thing to get around. And we do it because we've done 17 times, and I've been there for more than 10 of them. I joined in 2009. And people, when we take them public, people send, congratulations. It's a wonderful thing. And I got to tell you, we're thinking like, hey, this has just begun. Now, if you spread out the risk and the number of people you have, there's some people that have to take profits early or take liquidity early. But I'm going to tell you, we do a pretty good job of bringing in investors that believe in the technology and can see the company. If the company's dream is still alive, they're not looking for a 30% return, which isn't bad, maybe in a year or 2 years, obviously, but they're looking for multiple times on their investment, which is what you guys have seen in your career over and over again, because I've heard your stories.
So what kind of investors? Are you looking at family offices, individual, institutional?
I love you, David. That's a great question. So it's a balance. I think what we're doing is unusual. It's a balance of angels, high net worth, savvy, sophisticated, curious individuals that understand what the technology, or at least able to do their diligence and their work to a certain extent, balanced against institutional. But the institutional that we look at, because we're looking at smaller valuation type IPOs and funding, it's not the Fidelities of the world. It's not the big, it's not the Sequoias, or it's not the, the venture guys aren't going to do our deep tech anyhow, typically. We're looking at RIAs, registered investment advisors. We're looking at some family offices that are allocating to venture, and they're tired of paying 2 and 20. And they'd like to have, they're tired of the 7-year hold as well. I was just at a family office private equity conference yesterday in Chicago. And let me tell you something. If you say venture, they turn around and walk. They don't want to talk to you.
Yep.
So, I'm literally, a guy told me, he goes, hey, when you said I introduced myself to the group. And he said, when you said you were in venture, I thought, oh man, I'm sorry. He's a private equity guy. And then he goes, and I realized you're really not venture. You are a hybrid version of venture. So there's some stuff going on that, is under the current that I didn't even know about until, that conference yesterday. So we're really trying to have a mix. And the idea, David, is that you never give anybody, because we call it public venture. It's not public sure thing. So if you're going to bring individuals in, it's got to be the right size that nobody gets over their skis. And if it's asymmetrical enough in the opportunity, you don't need to put a lot of money in to have a great return. We're just different. We're just different, and we only do rifle shot. We don't shotgun it.
So this leads to a lot of questions. One of them, do you act as the underwriter?
Yeah, we do. So we have our own fully clearing broker dealer, and there's a conflict there. But we had to do that. We didn't want to, because that took us 3 years and more money than we wanted to spend to get through the regulatory process to be a fully clearing broker dealer. But guess what? The broker dealers out there did not want to look at public venture deals. They want to do the next Tesla, the next, rocket ship, go to space, whatever, And so in order for us to be able to access the public markets, we had to have our own broker dealer. So when we did a private placement, we knew that we've already made the decision that's going public, in the next 12 to 18 months. So it was out of necessity, basically. Does that make sense?
Sure.
Yeah.
And so does that mean you're also going to be the one that supports it? If you're the underwriter.
That makes us wince a little bit, because we do not want to be known that there's good and bad to that, right? You want to support the technology. We're going to support it in ways that we think are healthy. But these are children that are graduating, gone to college, and we want to support them in their college days. But we're not going to helicopter parent in and do everything. So these companies, if they're going to go into the public markets, they got to live on their own in the public markets, and that's really important to us. But that comes back to David's question about, well, what's it look like? Because our whole deal is we don't give angels enough of a bite that they're satiated. So once you get past some points and they're still up to speed on the story, and the story is a great story, that those angels come in and buy more in the public markets. And then there's a point that when you don't get to $1 billion market caps on our strategy unless the market comes in and bails you out.
So I think that's an important point that I think a lot of the angels don't think about is successor investors.
Oh, really?
Yeah. So there's a concept in stock trading: when the market goes up, you ladder up. Versus the other theory is you catch a falling knife and you get killed, But if what I'm hearing, tell me if I'm wrong. Yeah, I don't want to do that. But if what I'm hearing is that if we invest in a company, we take another round, and then this company is ready for, going into the IPO, we have another shot at getting into that IPO through MDB, so we can now kind of ladder up into additional valuation.
Yeah, I mean, you nailed it. I mean,
I like that approach.
Well, and look, the IPO, if we're doing that private placement to that IPO, we know there's some value inflection points in there that would give that one and make it much more, because we're giving them money to get the business rolling and such. That by the IPO comes, now it's been de-risked. Hopefully, if it works out, it's been de-risked. And it's exciting. And so you'd go, well, I had a little bit in that private placement. It's great. But yeah, I need to have a little bit more of a bite, because I'm going to be locked up for 6 months post IPO. I'd like to have some IPO shares that I might be able to, if I have to, I can trade and take some chips off the table. 100% of the IPOs we've done have doubled. Usually within the first 12 to 18 months of post IPO. Now, some of them didn't stay there. I mean, I try to tell people, hey, it's not like this. It's like this. And
of course, I want you to guarantee this. I don't want this. I want that.
It's not for the faint of heart. And I made the mistake multiple times to put my own family members in these things, and it makes Thanksgiving more uncomfortable.
Of course,
they're not doing well.
Yeah. Okay, so George, give me the mechanics of this. Who makes the investment first, the angel or you? And what percentage of the company does your company normally own at the point of the IPO?
It's all over the map, and it's on a case by case basis. If we put all the money up, we're going to own more of it. Typically, where we are now, because we've had such an investment in the broker dealer and getting the business up to speed, we would typically probably put the first investment in and form the company. Right now, we'll take a carry on by finding the companies, putting the management together, putting the board together, doing all the paperwork, bringing in the legal team, the whole 9 yards. We form the company. People call that a venture studio. I don't know what a venture studio is. Yeah. They told us we're a venture studio. We didn't know that until about 2 months ago. So we are, I guess. But we'll at times we'll have to pay some bills, or we'll have to pay some licensing fees to the university if you have to get the IP, freed up so it's in your formation. But so it's all over the place. Sometimes this Exozyme, we own almost 68% of it because we put all the money in, and then by IPO we're at 48% now post IPO. It's a big investment for us, but typically it's going to be somewhere between 10 and 15% post dilution. That's what our strategy is. And then there's some that we don't, all we're doing is bringing the money, which we'd prefer not to do, that we'd own a very teeny bit. It might be less than 5%.
Got it. Are you acting as the general partner? You mentioned carry, so that sounds like there's a separate general partner.
They're not limited partnerships typically, so we're not a general partner, but I think we'd be the kind of the lead. And I think, Dave, where we're going is as we've got, one of these eggs hatch and we have a big payday, which the history tells us it's just a matter of time. We're going to have that. We'll start writing kind of sizable checks, and we'll be like a lead. So we would come to, if TCA brought an idea to us, we'd say, okay, we're going to put, $5 million in, and then our community of angels will come in with us, and we'll be pari passu. Right now we're getting.
That just piqued my interest. You say $5 million. You had me at 5. You didn't even have to say the million.
Well, I mean, that's down the road. Okay, we might be 5 right now.
I mean, I can wait 6 months.
So, you get one of these. I mean, Exozyme could easily. I think it's going to be our biggest company that could easily create enough capital that's what we'd really like to do, is be more of a principal. And that was originally the idea. It's just that, it's a lot more difficult to start up this model than we ever anticipated. It was, we've used cash. We're really keeping the cash now. So it's, until we have a couple big winners, we'll find them, curate them, put them out, and we'll bring our community in and other communities to help vest them and get them launched into the public markets.
Yeah. Before I turn this over to Dave for a wrap, because we're going to run out of time, I have one question, then I'll leave it for Dave to ask any final questions. What advice do you have for founders? Is there something that they can do when they start the process of funding to make them more ready to go to somebody like MDB Capital so they have that opportunity to do an IPO?
Wow, that's a great question, because I'm typically not dealing with the founders. I'm dealing on the other side after the founders have been found. But I will tell you, it's, from what I see in the relationship, it's no different than who do you figure you'll want to go on the playground with. You go with people that you're comfortable with. When their name pops up on your phone, you can't wait to answer the phone call. It's a lot more for us. You're going to spend a lot of time with these people. They're going to be people that you want to do business with, that are curious, they're hard worker, they're passionate. We found a lot of founders that have come out of really big companies sometimes don't have the fire that someone who's had some failures. Failure does not impact us. We just know you learn so much from that. And then, we're open to founders that if it's too good to be true, we want to hear about it. We have the ability to diligence and figure out if it's a real flywheel or a perpetual motion machine. Does that make sense?
Yeah,
sure.
Probably as good as I can do on the founder side.
Okay, so let me see if I can wrap it up with a statement as if I were hearing this podcast for the first time.
Okay.
MDB either acts to find deals and bring them to investors like angels before the public offering, or MDB finds from those angels or angel groups deals in which you're willing to help to move toward the public offering. And you act as the underwriter. And if you call that Series B, it means you stay involved and you watch these companies and sometimes help these companies to get to the largest company they could possibly be. How close am I to that? We
believe, if you take a look at our back test of our 17 deals, the best IRR was probably within, it was 2 to 3 years post IPO. So that would be, you're probably 4 years of having liquidity. Now, if you're a buy and hold guy, you can hold them 7 years. It turned out the IRR is not as good if you hold it longer. I'm glad you clarified that, because that's one of the greatest advantages of what you offer. Yeah. You just said it.
And I'm excited about working with people like MDB, because I think from a portfolio approach, it helps diversify and it helps reduce my risk. And also, I like the fact that it's the way to get quicker liquidity, which was the subject of our discussion today.
Well, and by the way, just to throw what you guys have just said, we need to lean heavily on that mentoring and that, because I think it is a difficult concept to explain to people. So I appreciate your support, and anything you can do to help us to better, for people to understand that. I think there's a lot of opportunities if we pull these angels together to help innovate and finance.
I think you need to hire Dave Berkus as your marketing guru. He hit the elevator pitch on the head.
Well, not quite.
It was in the back of my mind, actually. I actually was thinking that.
And I was just about to say that George did the best job of summarizing all we needed to hear. But either way, this was a great opportunity to hear more about you and about MDB, George. And so we thank you for that. And we are fans. That'll help.
Well, right back at you, TCA's. We're with the Lakers of the NBA. So, well, not this year, but you know what I mean. You guys are top notch. We're just so proud to be associated with you. Thank you.
Yeah, we wrap it and wish everybody good investing. For the entrepreneur, you see another path through angels, through MDB Capital to be successful and be on a big board or in the nasty. Take a choice. And for those investors, here's another opportunity to look at using angels and the angel community, such as TCA Venture Group, to find different opportunities can be good for diversification of your portfolio. And with that, I wish everybody great investing.
Thank you.